Hey there, and welcome to this explainer. Today, we are absolutely decoding the secrets of evaluating companies and building real wealth. We're looking at how you, especially younger investors, can shift from just hoarding cash in a drawer to truly investing it. Because if you're a youth or a young adult looking to set up your financial future, you have an incredible built-in advantage, and we're going to break down exactly how to use it. So, think of your money like a little seed. Our goal isn't just to keep it trapped in a piggy bank. It's to grow it long-term into this massive, thriving tree. But to do that, you've got to start with SMART goals. Making sure your financial targets are specific, measurable, achievable, relevant, and timely. A piggy bank is totally fine for saving up $100 for a new gadget. But to grow that giant tree of wealth, you need to put your money to work through fundamental investing and the sheer magic of compound interest. Here is our roadmap for today. We're going to breeze through fundamental versus technical analysis, valuing large caps, soft indicators and sentiment, the three-fund portfolio, and finally, why long-term beats market timing.
All right, let's dive right into Section 1, Fundamental versus Technical Analysis.
The absolute crucial point I want you to take away here is that we're going to focus on fundamental analysis to find long-term business value. We are absolutely not treating the stock market like a casino with short-term technical day trading. You see, technical analysis relies on staring at stock charts and trying to predict super short-term price action, which usually requires like a dozen monitors and a whole lot of stress. Fundamental analysis, on the other hand, looks at the actual roots of a business. We're talking revenue, net income, free cash flow. A fundamental investor buys an undervalued company and just patiently holds the shares, waiting for the market to eventually realize its true intrinsic value. Next up, Section 2, Valuing Large Cap Companies. So, market capitalization. This just refers to the total size and value of a company. Now, microcap companies are tiny and super volatile. Those are your incredibly risky penny stocks. But large caps, these are the heavyweights. We're talking established, stable companies valued at over $10 billion. Think of your Apples, Microsofts, Googles. But here's the catch. Just because a $10 billion company is stable doesn't mean you should buy it at literally any price. We still need a solid way to figure out if we're getting a fair deal. Enter the price to earnings, or PE ratio. Seriously, the PE ratio is kind of like your valuation cheat code for identifying undervalued $10 billion behemoths. Basically, it measures how much you are paying for exactly $1 of a company's profit. So if a company's PE ratio is 20, it means investors are paying $20 for every $1 of profit. If you flip that around, it means the company's generating a 5% earnings yield on your investment. So looking for companies with that really healthy 5% yield, which means a P of 20 or below, is just a fantastic way to hunt for bargains compared to the broader market. Let's look at a real-world example and compare two massive tech giants. Apple is currently trading at a PE ratio of roughly 38. This tells us investors view it as a super high-quality, blue-chip business that's worth paying a steady premium for. But then look at NVIDIA, trading at a PE of around 53. NVIDIA's much higher PE ratio shows the market is totally pricing in explosive future growth, likely because of all the massive frenzy surrounding their AI chips. Basically, the higher the PE, the more future growth the market is already expecting and already paying for today. Moving right along to Section 3, Soft Indicators and Market Sentiment. Now, evaluating stocks isn't just about crunching hard math. You can actually spot long-term winners way before the broader market does, just by paying attention to soft indicators and overall sentiment. Take Robinhood back in early 2024, for example. Traditional Wall Street analysts were pretty bearish because of all the old GameStop drama, but the soft indicators were telling a completely different story. Reddit users were overwhelmingly still posting screenshots from the app, the company was rapidly launching cool new features and credit cards, while legacy competitors were basically snoozing. Plus, it was still run by its founder, meaning the leadership had that really gritty drive to see it succeed. By tracking strong community sentiment and finding visionary founders, you can spot incredible hidden value that traditional spreadsheets might completely miss. All right, let's shift gears to Section 4, the three-fund portfolio. If analyzing individual stocks and PE ratios sounds like way too much homework, do not worry. This is your golden ticket, the three-fund portfolio. It's this highly effective, literally set it and forget it strategy. Instead of betting on single companies, you just buy broad index funds or ETFs that track entire global markets. A classic breakdown goes like this. Put 60% of your money in a total U.S. stock market index, 30% in an international stock index, and 10% in bonds. This combo effortlessly balances aggressive equity growth from all over the globe with a really nice baseline of reliable safety. Let's focus on that 10% bond allocation for a second.
It might seem kind of small, but it acts as a crucial shock absorber against the wild, unpredictable volatility of the stock market. See, because bonds are essentially just loans you make to a company or a government that pay you a fixed interest rate, they don't swing wildly up and down like stocks tend to do. By blending this 10% fixed income safety net with 90% high growth equities, beginners can comfortably ride out almost any market crash without panicking and selling everything.
And that brings us perfectly to Section 5, long-term beats market timing.
The absolute biggest mistake I see beginners make is trying to time the market. Sitting on a pile of cash, desperately waiting for the perfect dip to buy in. But history proves over and over that time in the market always beats timing the market. You should really just keep buying. The S&P 500 has historically returned an average of 8 to 10% per year. If you start consistently investing right now, by year 10, your money is literally making its own money. By year 20, you've absorbed and overcome multiple market crashes just through those long-term averages. And by year 30, get this, a consistent $1,000 monthly investment could balloon into over $1.5 million. You don't need to get lucky. You just need to be disciplined.
In today's frantic world, patience is incredibly rare. As Jeff Bezos once noted, if you operate on a 3-year time horizon, you compete against literally everyone. But, quote, if you're willing to invest on a 7-year time horizon, you're now competing against a fraction of those people. And here is a totally crazy fact for you. The average holding period for a stock today is hovering near an all-time low of just 10 months. Think about that. Most investors are incredibly impatient. Simply extending your timeline automatically puts you miles and miles ahead of the competition.
Which brings us to our final takeaway. As a young investor, your investing runway is longer than 99% of the players on Wall Street. You do not need to be a financial genius to build wealth. You just need to harness the simple math of compounding, ignore all the short-term noise, and let time do the heavy lifting for you. You possess the ultimate investing superpower. So the only real question left is, are you going to let time just pass you by? Or are you ready to start planting your seeds and making it work for you today?